Welcome to another exciting edition of the Real Estate Mentor Podcast, the #1 real estate mentorship podcast on the internet today. I am your host, Jonathan Klunk, coming to you from Louisville, Kentucky. And today we have an amazing guest with a very, very interesting and novel concept in fractional real estate investing and ownership, coming to us from San Francisco, Frank Rohde. And today we are excited to welcome him. He is a visionary founder and CEO of Ownify, and he is revolutionizing the real estate industry, as I mentioned, with groundbreaking fractional ownership model that is making homeownership more accessible, especially for first-time homebuyers. He has a rich background in fintech, data science, and real estate pricing from his time where he was CEO at Nomis Solutions, and he brings a wealth of expertise to this table. His innovative platform, Ownify, is shaking up traditional notions of homeownership by allowing buyers to purchase homes, quote, brick by brick, opening doors for those who might otherwise be priced out of the market. Frank, thank you so much for joining us today. I am more excited than you probably know to have this discussion.
Thank you, Jonathan, and thanks for having me. And I hope I can live up to that introduction.
I hope you can too, but I have no doubt. Let's start with some of the listeners and viewers who might not know what fractional ownership is. Can you give us just kind of a brief nutshell of that?
Yeah. If you think about the way we've owned homes traditionally for the last 70, 80, 100 years, right? You buy 100% of the ownership interest and the title effectively to a property. Depending on the state you live in, that might have various versions. But the way most everyone does that is you go to the bank or mortgage lender and you borrow a large amount of money, and the mortgage lender effectively finances a large portion, right? You put down your down payment and you buy 100% of the title or the ownership, and then you pay that off over time. And there's, that's certainly a good way to go for a lot of folks, and there's some advantages to it, but there's also a large number of disadvantages. And so where we approached this question of how do we help first-time homebuyers in particular, we started out by challenging that notion of why do you have to buy 100% of the home, right? And then pay off all this debt over 30 years or however long it takes you. Why can't you buy your home brick by brick or, piece by piece? Why can't you buy a smaller portion of the home and, maybe rent the piece that you haven't bought? And so we went down this path and did a lot of research, a lot of legal work, and ultimately ended up with this structure that allows a first-time buyer to pick a home off the market and then buy it brick by brick or, piece by piece over time. And I'm happy to dive in and dig into how exactly that works and what some of the pros and cons are of that approach. But
yeah, I was going to say, I want to look at this from both sides of the fence, the buyer and then the investors who are, in essence, acting as the bank in a transaction like this. So first of all, tell us about your target audience from a home buyership standpoint. How do they find you? What are some common traits or things that you find among your buyers when you dig into their reasons for going this route versus a traditional route?
Yeah. So maybe just a little background here. My background is in mortgage pricing and loan pricing, and I built a software company that built the software that most of the large mortgage lenders use to price loans. So spent 15 years in the bowels of mortgage math and really digging into how that product works. And
sounds like an
one
exciting
of the things,
place.
super
The bowels
exciting.
of mortgage math.
It is actually really fascinating, right? And there's a whole industry, obviously, with millions of people that are associated with it. But one of the things that we kept seeing in the data more and more is that first-time buyers are getting squeezed out of the market. And I'm sure everyone kind of knows that story anecdotally in your circle of friends and acquaintances. But when you dig in and you try to take apart why that is, there's a number of reasons. And everyone knows home prices continue to increase, right? And so you have home prices, you have mortgage rates that have reverted to their probably long run average, right? They're higher than long run average, but they're going to go down maybe to the 6 and 5s, right? But they're not going to be back in the 2s anytime soon. So you have mortgage rates that are higher than they've been over the last couple of years. You have a lot of corporate buyers, right, and cash buyers, and so a lot of first-time buyers are getting squeezed out or can't compete with a mortgage-based financing solution. And so the sum total of all of that, right, is that we've seen more and more first-time buyers getting squeezed out. So unable to either qualify for financing in the first place, or even with financing, unable to win the deal.
Hmm.
And so what we tried to then challenge is this notion of, okay, well, why do you need a mortgage? Why do you need to buy 100% of the home? Can't we buy a home, brick by brick, as I mentioned earlier? And so the perfect buyer for that, to answer your question, or the target buyer for this, is someone who has solid income. So right around the area median income. These are not Google engineers, but they're teachers and creative types and firefighters and people who live in your community, who you want to have in your community, and who make decent income, but not an extremely high income. And secondly, they have good credit, so they've been smart about how they manage their finances. So they have good FICO scores, good credit scores, but they haven't saved the down payment. So if you think traditionally about the three things you need to buy a home, you need income, you need savings, and you need good credit. And so
Hmm.
our target buyer, our persona, and the folks who've used Ownify successfully to buy homes has solid income, good credit, but hasn't been able to save the down payment. And then when you double click on that and say, well, why haven't folks saved the down payment? Well, one, student debt. A lot of times, student debt weighs down the ability to put money aside. Two, inflation and cost of living. And if you live in any major metro area, that's been expensive. Rents have been rising. So cost of living, student debt puts pressure on homeowners or aspiring home buyers. And the persona that we found is someone who should be able to afford a home, but doesn't have the help with the down payment, right? And a lot of folks have help from families, which is great, whether it's a gift or a loan. But there's also a lot of folks out there, about half, who don't have that leg up or that step up early on, and that's what we're looking to provide with Ownify.
So, would you say that this is effectively a potential 0% down payment solution for first time home buyers?
You
Or do they
could
need some
right
skin
now
in the
we're
game?
doing yeah, I mean, right now we're doing 2% down payment, but there is no reason why we couldn't go to 0% because, and we get into that probably a little later, the structure we've built removes some of the moral hazard of a zero down payment mortgage, right? Where you can create this problem of negative equity. But the way to think about Ownify really is, it's an on-ramp for first-time home buyers that helps you jump over that down payment hurdle, helps you get into a home earlier, right? Puts you on the path to ownership with an all-cash offer in a competitive market.
Okay. Certainly, the all cash offer is, I think, reason enough to look into something like this. I've had a lot of clients lose out to all cash offers, especially in competitive offer situations where there's no chance in hell that they're going to be able to come up with an all cash offer for anything they want to purchase. So, very often you have to look at value add opportunities. You have to look at houses that are, you know, well within your means, which might not be in areas or property types that you'd want, especially with rising home prices. So I think that that's a very attractive and compelling offer to somebody as well who's been in situations like that.
That's
You
exactly
meant
right. We hear this all the time from our acquisition model is through realtors and broker partners, and one of the big things we hear from our agent partners is the all cash offer, right? Putting that on the table, it significantly increases the win probability for that first time buyer.
absolutely. You mentioned there are obviously pros and cons to working with a solution like this versus a traditional lender or bank. Can you go over some of the pros? What besides all cash offers, what makes this a much better solution?
Yeah. So the all cash offer is one big benefit, right? And we've seen that increases your win rate from 10-15% with a traditional mortgage to 75%, which is what we've seen. The second big benefit is what we call evergreen equity. And so this gets into some of the technicalities on how the purchase program works. But in a nutshell, we allow the customer to buy the home brick by brick or fraction by fraction without debt leverage. And what that means is that every month the customer makes a payment towards equity, and that buys roughly 13 bricks. There's 10,000 bricks in each home, or 13 basis
Hmm.
points of the value of the home. If the home price goes down, you end up buying more bricks with that same payment. If home prices go up, you end up buying slightly fewer bricks. But since you're making a payment every month over a 5-year horizon, what effectively happens is that the customer dollar cost averages the purchase of the home. They buy more on the dips and they buy less on the peaks, right?
Hmm.
And because there's no debt involved, that equity that the customer is building, starting with 2% on day one and then ending roughly at 10% at the end of 5 years, that portion can never be zero. It can never go below, in the sense of negative equity that you could have with the mortgage. it can never be worth less than what you owe because there is no outstanding balance. There is no principal, right, in this structure. And so what we've removed is this risk that a lot of first-time buyers, especially with low down payment mortgages, face of having negative equity. What we saw in 2009,
Yeah.
2010, where you had people get into houses and then home prices fell, right? And all of a sudden you owe more for the home than it's worth, right? And you're making this payment to the bank for something that doesn't feel
Yeah.
particularly great. And
Yeah.
so for
That opens the
the
door to foreclosure because sometimes that's the best business decision for what you're in. Obviously, nobody wants their home to be foreclosed on, but if you were underwater too much, especially in these major markets, it's like, why do I want to continue paying on this much more than the value of the property is? Kind of like the stock market. When it goes down, you want to sell, even if it's negative. Take that loss versus waiting 5, 10 years to see if it comes back up to that value.
So this evergreen equity piece is a real advantage to the structure we've built, this fractional ownership structure. We talked about the low down payment and the cash offer. The fourth benefit really for the first time buyer is that we cover repairs and any sort of major issues with the home for the first 5 years.
Oh,
And
wow.
so a lot of times when you talk to younger first time buyers, one of the things that scares them is, one, I have to come up with this down payment.
Hmm.
And then once maybe I make that hurdle, now I live in the home and I'm what everyone calls house poor, right? I can make the payment, but I don't have a savings cushion. And now what happens if the water heater breaks, right? Or the roof needs replacing or some other major thing in the home? And we cover all of that as effectively your investor partner, right? And your co-owner in the property. And that removes a lot of uncertainty and risk for the first time buyer for those first 5 years. So one of
Yeah.
the ways in which one of our customers called it, it's like home ownership on training wheels, right? You're getting the benefit of picking the home, living in it, owning a fraction of it, but a lot of the risk is also removed
Hmm.
because of this evergreen equity piece and the fact that we take care of repairs and maintenance.
Yeah. It's the hidden costs of homeownership is what we often call that. And those can often be significant depending on the house. You're effectively a little bit of a home warranty company when it comes to that. So are we talking roofs if it's not covered by insurance, water heaters, toilets, or is it just major things? Is it just minor things?
It's everything related to the habitability of the home, right? And again, the way legally the structure works is that the customer is a co-owner in this limited liability company and the entity that is set up to own the home. And that entity takes care of all of the repairs and maintenance related to the property. And because the entity is largely owned by investors, the investor base, the pool of investors actually takes care of most of the major costs.
So let's switch to the investor side for a second. I understand why investors would want to invest in something like this. It's almost like an ethical or sustainable type of investment where you can put your money into something and feel good about it at the same time. I'm sure that they're getting money, they're getting paid. I'm sure you're getting paid for offering this service. So talk to me about from the investing standpoint and also from the homeowner standpoint, how does this look like, let's say, on a monthly basis? If the homeowner is going to make a payment, I assume that's going to include interest that's going to be paid out to some of the shareholders. Maybe not. I think that the homeowner is gaining equity, so they're probably not going to get interest payments. And then again, you're going to have a fee for the service that you're offering. How lucrative is something like this for investors? And is that more a positive or negative net to the homeowner versus the traditional model?
When we built this, right, one of the key pieces to really work on is to make sure that the benefits are fairly distributed between the first time buyer, the ONI, and the investors, right?
Equitable,
If it's
yes.
lopsided in some way, shape, or form, then you're either providing, if you're providing a huge benefit to the ONI without being able to provide benefit to the investor, then you can't attract capital and you don't have a solution, right? And you can't help anyone.
Exactly.
Too much benefit to the investor at the expense of the ONI. Some companies have done that. The problem is, you end up getting sued by ONIs and consumer advocates, and it's not sustainable either. So we spend a
Right.
lot of time building the math such that both parties benefit. And so for the ONI, we've already talked about low down payment, affordable monthly payment, taking care of repairs, maintenance, et cetera. For the investor, and we are sourcing and attracting and onboarding accredited investors into a Reg D fund. So you have to meet that SEC hurdle. But in that fund, we're targeting a 15% IRR, internal rate of return, so annual return. And the reason we can get to a 15% IRR is that the value prop actually is based on some of the benefits that the ONI sees through co-ownership. And those benefits ultimately come back to the investor. So what are those benefits? Well, the first one is that we have zero vacancy, right? So across the portfolio, we've onboarded homes. We buy homes once the customer has identified them, and they start paying rent on the fraction of the bricks that they haven't bought on day one, which means there's no lease up period, there's no marketing period, right? We don't have vacancy up front. We also have had zero turnover. We've had zero late payments, given that the portfolio right now is about 740 average FICO score. So, very pristine credit. And we've not had any kind of performance or late pay or any of the issues there. So you have those dynamics. And then because of co-ownership, one of the interesting things we found is that the maintenance cost that we've incurred on the portfolio of homes is about 60% lower than industry average, because people are co-owners, they're taking care of their properties, they're painting, they're repairing, they're doing the things that normally a tenant would call their landlord and say, hey, the toilet is broken or the light needs fixing. As a co-owner, you take care of those things yourself, and that ultimately benefits the investor pool as well. So between lower vacancy, lower turnover, lower maintenance, repair costs, we can increase the return to the investor through the kind of behavioral change, right, that co-ownership really generates. And that's what gets us to that 15% IRR. And so far, we're well on track. Now, if you look at the investors who've come in, a lot of them, I'd say more than half, are really interested in the mission, right? The social component of I'm investing in my community, I'm investing in homeownership. Homeownership is a net positive, right, for communities. And I'm supporting younger families getting into houses. And I like that mission in addition to the financial returns, right? So there is that double bottom line that we're really focused on.
So walk me through the way that this is structured. It sounds like we're creating a partnership here. There's 10,000 bricks, so let's say 10,000 shares inside of the partnership. The homeowner comes in with a certain number of these bricks, not, I guess, what is that? 2,000? 200 minimum. Sorry,
200, yes. So 2% of the
200
10,000.
minimum. Every month they make their payment, then they're acquiring more bricks. Is that in essence diluting the other investors' stake in this?
You could call it that. It's not diluting as much as the investor pool is selling bricks every month to the ONI. So the way the structure works is, as you correctly point out, on day one, the ONI comes in with 200 bricks. The investor pool, the fund, comes in and buys 9,800 bricks. So that's day one, right? 1 month in, 30 days later, the ONI makes a payment. And the payment, by the way, is fixed for the 5 years. So the ONI knows I'm on the hook for whatever the payment is, right? $3,000 a month for the next 5 years.
Okay,
That
so like a 5-year
$3,000
term with a balloon.
There's no balloon, but
Okay.
we'll get to that. Because there's no balance, right?
So much information. It's going to be really hard for me to structure these questions and piece this together because it's so fascinating.
This is what's so fascinating, right? Because we've thought about real estate in the same way for so long, and everyone who's in the space kind of has exactly the same questions you have, right? Like, well, interest and a balloon payment, but no, there is no interest and there's no balloon, there's no balance. There's just the ability to buy these bricks, right? And the bricks, as you pointed out, are membership interests in the LLC or shares of that limited liability company. So there's 10,000 shares total, 10,000 bricks. The only starts with 200. Investor pool owns 9,800. In the first month, the customer makes a payment. That payment is split into two components. One component pays rent on the 9,800 bricks, right? And that's market rent, and it's fixed for the 5-year period. At least the yield is fixed, right? As the number of bricks goes down, the rental payment actually goes down, but the yield to the investor is fixed. So the investor gets a rental return on however many bricks, right? 9,800 bricks on day one. The second component of that payment is a payment that goes towards buying roughly, and I say roughly on purpose, 13 bricks or 13 basis points.
Okay.
And the way that works is that there's a payment, a dollar amount, and we calculate the value of each brick 1 month in. The way the value of each brick is calculated is we run an evaluation process. We use automated valuation models on each property, and we use a number of them. And actually, we average them, and we come up with the value of the home. We divide that by 10,000, add in whatever repair costs we may have had, et cetera. But we establish the value of that brick. And so let's say you make a payment of $400, and the bricks are worth, for simplicity purposes, $40 each. You buy 10 bricks in that month.
Okay.
And the way the math is dialed in is you buy roughly 13 bricks. It could be 13 and a half. It could be 12.8, right? Depending on the value of the home in that month. And 13 times 12 gets you to roughly 1.6% or 160 bricks. And over 5 years, that gets you to roughly 800 bricks or 8%. Plus the 2 you put down gets you to roughly 1,000 bricks or 10% of the value of the home at the end of 5 years. So the way the program works is that the customer buys equity, buys bricks, stacks up their bricks, and at the same time rents the bricks that they haven't bought. And as your stack of bricks increases, the stack that you have to pay rent on decreases. Now, you mentioned the point there's a balloon, right? What happens at the end of 5 years? At the end of 5 years, the customer will have built roughly 1,000 bricks or 10%.
Mm-hmm.
The investor pool still owns 9,000 of the bricks, and the customer has a purchase option. And that purchase option is valid through the entire 5 years. At any point, the customer can exercise a purchase option and say, I want to buy the home the traditional way, right? I buy the title from the LLC at the current market value. And the current market value is the same value that we establish every month, right? So it's not a mystery. There's no surprise. Well, last month you paid $40 for each brick. There's 10,000 bricks, so the home was worth $400,000, right? This month, if you're paying $41 a brick, the home is worth $410,000. So the value of the home is known every month. And the customer has the purchase option to buy the home from the LLC and effectively buy out the investor pool.
Okay.
Right? And they can do that once they qualify for a mortgage. So, and the reason we dialed the math in so that the customer builds up to 10% equity is that with 10% equity, right, 10% of the owner or of the value of the home, that is what you need for a conforming mortgage, right? As a down payment, you can go out, get that mortgage, take all the time you want. You know the purchase price because it's the current market value, and there's no other bidder, right? So it's not a competitive situation where you need to now go through the whole rigmarole of figuring out, well, how much do I need to offer? You know exactly how much you need to offer. You can get your mortgage in place and then buy the home from the LLC. And so that's, in a sense, the path here and the structure, right? It's this on-ramp into ownership that allows people to get over the down payment hurdle, right? Build equity over time, have that security of evergreen equity and, the fact that we take care of repairs and maintenance. And then when they're ready, they buy the home the traditional way.
Okay. So tell me how a mortgage payment stacks up to today's interest rates. I think that, we're back under 7%. And, with the poor jobs report last week, they're coming down a little bit more, as is the stock market globally, with Japan taking the biggest hit of that brunt, I think. So how do interest rates? I assume that you maybe have some sort of an interest rate component that is factored in over that 5-year period and then, perhaps might adjust after that. Tell me how the interest rate compares to the monthly payment from a similar interest rate at a bank. Are there any additional fees and things on top of that? Do you collect the escrow for them as well?
So we don't have an interest rate per se, right? There's really only a rental yield calculation. Now, rental yields in the markets that we're in, the way we establish rental yields is we look at what are the rental yields in the market competitively, right? And they tend to be in the 6, 7, 8, 9, 10% range, depending on the property. So the payment that the customer makes and the yield that's paid back to the investor pool is really driven by competitive rental yields. Those in the long run tend to adjust as interest rates go up and down. But in the short run, there's no direct link between market interest rates or the 10-year treasury and the rental yield we're charging. So what does that mean? It means that for the ONI, right, for the home buyer, today, when you look at our website, you can go in and you can run these competitive comparison scenarios to say, for a particular home, how much is Ownify going to cost me per month and how much is a mortgage going to cost me?
Mm.
Today, we're actually a little lower than the all-in
Wow.
mortgage cost. If you take into account that the mortgage borrower, the mortgagor, also needs to account for repairs and maintenance.
And
So
mortgage
including
insurance.
and mortgage insurance, right? Exactly. If you have PMI or depending on the structure, you have mortgage insurance, you have taxes, right? And you have repairs and maintenance that you need to
Yeah.
pay. So the all-in cost today of an Ownify monthly payment is a little lower than the equivalent for a mortgage. That may not always be the case, right? Mortgage rates come down into the fives or into the fours. The monthly payment, all in, including interest, taxes, insurance, etc., may be lower on the mortgage side, but you have this additional benefit on the Ownify side, which is you only put 2% down, right? So if you look at it as a package deal, so far, I think all of our customers have been significantly better off. And what we track on the website is how much in down payment savings have we generated, how much in monthly savings have we generated. And right now, the monthly savings number is somewhere in the $240. I haven't checked it recently, relative to what you would pay with a mortgage.
Okay. Yeah, that sounds like a valuable tool on the website. I'll definitely check that out. So I had a great question right on the tip of my tongue, and now I'm thinking about running through these numbers on the website, and
No, don't worry, I'll
completely
do it
lost
for
that
you.
one. Yeah, so obviously there are a lot of benefits here. I'm already thinking of clients and different people that from the end user standpoint, I think that this would work for. And with me putting my investor hat on, I am thinking about all the ways that I could invest in something like this and feel good about myself at the end of the day. I mean, my stocks are down. Oh my God, like
I don't.
overall, I'm like -6% right now. That's because I'm more of a swing trader. I don't hold things for too long, so I don't let them accumulate into 20 or 30%. I wait for that 8 and 10% return in less than 30 days, sell it. So, I'm kind of stuck with some things right now, deciding do I sell and take a loss or do I ride this out and how long is it going to take?
Yeah.
So, this seems like a lot more of a stable investment. And from a real estate investor, it sounds pretty turnkey. How does your organization step in whenever there are repairs, whenever there is a late payment every month? Who's the point of contact, and what role do members of this LLC have other than receiving mailbox money every month?
It's really, you're as an investor, you're a passive investor, right? You're getting passive income. We pay a quarterly dividend. The Q2 dividend is about to go out. It's in the order of right now 4% annualized. And then on top of that, you're getting your home price appreciation, right? Which isn't realized until we sell the home or the owner buys the home from the fund. So that could happen, that will happen over the 5-year horizon. So as an investor, you need to be accredited. You can qualify at ownifyfund.com or at ownify.com, and you can invest using your, cash, checking account, etc. You can invest using your IRA, your individual retirement account. You can invest using your donor advised fund or DAF if you have that, which is tax efficient in any scenario. And we have investors across all three categories. And so once you've invested, we are effectively your asset and fund manager. We take care of the properties, obviously underwriting of the ONI, valuation of the property, any sort of repair, maintenance, property management issues. We take care of all of that. As an investor, you don't have to deal with that. So you're not an active participant. You're a passive investor. You're getting your dividends, you're getting your statements, you're getting monthly newsletter on the and some of the stories of ONIs we've helped, which a lot of our investors really like those. And you're doing something positive with your capital, hopefully and ideally in your local community as well.
Does anybody benefit from depreciation since one of the members of the LLC is the primary resident as well?
Yeah. So as an investor, you benefit from depreciation. The LLC effectively, right? Each
Mhm.
home is owned by its own LLC. The LLC benefits from the depreciation, and that gets passed through to the investor.
And so I assume they'll
So
receive K1s.
correct. You're receiving a K1. Your taxable income is much lower than your cash income, right?
Hmm.
Because of that depreciation.
When I first got into real estate investing, I was a renter and I ran the numbers. And even after my first multifamily purchase, it made more sense for me to continue renting. than it did. I was paying, very similar for an entire house that afforded me privacy and a driveway. And I'm investing in multifamily where the monthly rents on each of those was not far off from what I was paying. Do you foresee any scenarios where people just continue renting homes, but maybe they invest their money instead of buying a house? Like maybe people who live in San Francisco, they want to get into real estate, but I mean, going to get, $1, $2 million home, it's like maybe I should just keep renting an apartment and invest my money into something like this rather than actually owning a home.
Yeah. I think that is a more and more likely outcome for a larger number of people. And at the end of the day, if you think about the home purchase, it really makes sense when you know you're going to stay somewhere for an extended period of time, right?
Right.
You have the transactional cost on entry and on sale, right? And not to get into the whole commission discussion around realtors and all that,
It's
but
all
they're not trivial.
changing.
Now, all changing. We should talk about our commission plan, which I think is really interesting. We spend a lot of time on that. But so you have the transactional, the cost, right, of getting into and out of the home, which means you should stay longer to defray those costs. And then you have the pure ability, right? You mentioned San Francisco. Most of the coastal cities are not dissimilar in that they are expensive, right?
Hmm.
And therefore renting may make more sense. You also have this notion or the fact that the mortgage interest tax deduction for most first-time buyers is no longer relevant, right? Because you're not making enough or your mortgage is not high enough to get you past that standard deduction. So you
Hmm.
take your standard deduction, you don't get the benefit of mortgage interest. And so with all of those things, the answer may be yes, rent and invest. But the important thing is invest, right? And one of the kind of silent benefits of homeownership, whether it's through Ownify or through a mortgage, quite frankly, is the forced savings mechanism, right? Is the fact that every month you're putting money into an asset that continues to appreciate. Whether you're consciously aware of that or whether it's just your mortgage payment, it's your Ownify payment, whatever payment you make, you're building equity, you're saving, you're building your nest egg, right? And as a renter, you're not doing that. So if you are diligent enough and self-motivated enough, right, to say I'm renting and every month I'm putting 500 or 600 or $200 away somewhere and I'm doing it consistently, then that's definitely a choice, right? I think the challenge for a lot of folks is they don't do it consistently, right?
Right.
And that's what prevents that equity accumulation and the savings benefit of real estate to really happen.
Hmm. So let's talk about the numbers for your company. How
Yeah.
many people are applying for this process? How many people do you accept? How many successful transactions have been done? And how many people have successfully exited as investors or as homeowners, in the past at that 5 year mark?
Yeah. So we're very early. We launched last year, so 2023 in Raleigh, Durham. We're live in Raleigh today. We're adding Charlotte, the rest of North Carolina, and we're launching in Nashville next. Kentucky's not on the list yet, Jonathan, so we'll
Huh.
we'll call you when we're ready.
Oh,
Um,
that's okay. I'm global, baby. You,
oh, you are okay.
you
Good.
don't have to be in Kentucky for me.
And so the reason we picked a single market is we wanted to make sure that we built the structure, right? It took us about 2 years to build the math and the legal structure and,
Yeah.
making sure that it all works. We've gone through a beta launch. We get today about 10 to 15 applications a day. We accept about, I'd say 2 to 3, maybe 4%. So, and most of that is because of credit. As I mentioned earlier, right now we have a pretty strict underwriting funnel because we want to make sure that we don't invite adverse selection early on. Having gone through this with other financial and lending related startups, there's a big issue with early adverse selection. So we're being very diligent. We've accepted about 60, 70 people into the program. We've closed on 7 homes. We have a good pipeline, and we think we're going to be at 30, 35 homes by the end of this year,
Wow.
largely in North
Brand
Carolina.
new. Yeah.
And the fund that we've raised, we have a $10 million fund that is funding these homes that we're accepting investors into. And as I mentioned, no one has exited the program, given that most of the purchases are literally brand new,
Yeah.
right?
Yeah.
Or less than a year old. And the goal is to, build about a portfolio of somewhere around 100 to 140 homes in North Carolina, and then launch the second fund and the second kind of, market shortly thereafter, right?
Okay.
Tail end of this year, early next year, early 2025.
So how do you mobilize the funds so quickly? Because, in a typical transaction, we're going to have a 30 to 45 day close. And sometimes to be competitive, if you come in all cash, they prefer a tighter closing timeline. We're going to want to look at 20 to 30 days. Do you have kind of a pool of investors that whenever you have an opportunity, you send that out to them, you try and raise enough capital very quickly within that period of time?
We don't syndicate each deal. We actually have a fund that we've raised. So there's capital in the fund. And then in addition to the fund, we have a debt facility that we use. And so between those two components, we have the ability to execute on a cash offer. I mean, within a couple of days. Right?
Hmm.
Theoretically, you close and wire money
As soon
within
as
24
title's
hours.
back and the
As soon as
appraisal.
title, yeah. And so, we've offered, and sometimes that has been a real benefit. We've had a 14-day close, right? And the seller was very motivated by a fast close. And so we can do that because there's no debt involved. We don't have an appraisal contingency or any of those things. Right. And again, that simplifies the closing process. My co-founder spent his entire career in real estate and has bought somewhere around 6,000 homes. So he's the expert on the closing process and ensuring that, from a pure operational perspective, we put our
Hmm.
best foot forward. And ultimately it's about, empowering the agents that work with us on behalf of their buyers, right, to win deals. And that's good for the ONI, for the agent, and for us, obviously, as representing the investor pool.
Absolutely. And so you mentioned a fund. So you have $10 million in this fund. I'm sure that that's growing. Tell us about the structure of that. So if I have whatever the minimum is to invest, what is it, like 25,000, 50,000?
25,000.
Okay. So I have 25,000. I come to you. I give you that money today. That money goes into a fund. Is it earning interest or anything like that until it's placed with a property, or does it just kind of sit there?
Yeah. So in full transparency, we're not at 10 million yet. The fund is pegged at 10 million. We're raising into the fund and we're raising at a good clip. The minimum investment is 25,000.
Hmm.
At 100,000 or more, we have a preferred return of 10%. So that's the kind of return that goes back to the investor as a preferred return before there's any participation by Ownify as the fund manager. And at 100,000 or above, that participation is 10%, 90% of the, any incremental returns above 10% also go back to the investor. So that's the kind of structure. It's a closed-end fund. It's a 5-year investment and it has a 15% target IRR, right, between the dividend that comes back as rental income and the home price appreciation that we generate over that horizon.
Okay. And so then whenever you have a qualified buyer, you have a qualified property, time has come to fund it. Do you take a specific person from within that group and that person is then a member of the LLC, or is the fund the member of the LLC and all parties kind of benefit from the outcome and performance of that property?
It's the latter. So it's a great question, Jonathan. So one of the things we want to make sure we offer to our investors is that kind of built-in diversification, right? So as an investor in the fund, you're effectively invested into all the homes on a pro rata basis, right?
Got it.
And the benefit of that is that if one home for whatever reason doesn't perform as well, you're not disproportionately impacted if you are the individual in that home. So we do the underwriting on the individual ONI and on the home, and the net return or the overall portfolio return goes back to every fund investor based on then their pro rata investment and however long they've been in the fund.
Okay.
And then I just realized I didn't answer your prior question. So the way the capital sits in a treasury account and earns some amount of money, but part of obviously our challenge is to ensure that as we source capital and we source ONIs, we have a balance here so that we don't have excess capital sitting around not
Yeah.
earning return or too much of a wait list of ONIs, right, without
Hmm.
capital to put them into homes. And so
It's a
that's one
tricky
of the
balance.
reasons and that's one of the reasons why we are very measured and targeted around launching in one market, figuring out exactly how the levers work between acquiring capital, investor capital, and ONIs, right? And if once we have those levers and we've dialed them in so that we know here's where we can push a little bit through marketing, through agent commission, through
Hmm.
outreach to get the next 15, 20 ONIs into the pipeline, right? So that we can close on 3 or 4 or 5 homes per month in September and October. And we know here's how much capital we then need to raise, right? And right now we're at the kind of 500,000 a month clip on the capital side and on the ONI side as well, right? And so the goal and the challenge for us is to increase both, right? So that we don't create this imbalance of, oh, we have too much capital, not enough deal flow, or too much deal flow, not enough capital.
Yeah. I mean, a really astounding operation. I mean, I'm looking at all the moving parts in
Thank
my
you.
head and I'm a little bit paralyzed thinking about running something like that. So kudos to you for putting all of these pieces together and leveraging all of the years of experience that you have to, be able to provide a product like this for both investors and for, homeowners and first-time homeowners. You
Well,
made a
thank you.
point about commission that you're really
Yeah.
proud of that. You put a lot of time into that. So I want to give you an opportunity to talk about that. I assume this is how
Yeah.
you work with real estate agents.
This is the piece where your realtor friends and listeners, right, and agents who are listening to this might appreciate this. As you know, the NAR settlement is about 2 weeks out, right, or at least the implementation.
Hmm.
And one of the impacts that we've seen already in Raleigh Durham is that the buyer commission has gone down, right? We've seen about a 20 basis point reduction just since the March announcement of the settlement and today. And we expect there to be further compression, right? Of basically selling agents or sellers saying, well, I'm not paying the buyer's commission. So what's going to happen? Well, the buyer agent provides valuable service. We see it every day. But if you turn to the buyer, a first time home buyer in particular, and say, by the way, now you have to pay your agent's commission in addition to all the other fees and things, it's going to get even harder, right,
Yeah.
for that first time buyer. So what we've done is we've launched a plan for our buying agent or our accredited agents who work on behalf of their buyers with us as the financing solution. And we call it the 2+10. And what's unique about that is we guarantee a 2% minimum commission or whatever the seller is offering to pay if
Hmm.
that is higher than 2%. So you have a floor on your commission. The 2% is on the list price, not the purchase price, the list price. And then we have what we call the 2+10. The 10 is 10% of the benefit that you, as the buyer's agent, negotiate on behalf of the buyer. So
Okay.
if you negotiate a lower closing price or a seller concession as part of the work you're doing between the offer and the closing,
Hmm.
you will get 10% of that. So let's say you make a bid on a $400,000 home. Your first piece is 2% of that $400,000 home. That's $8,000 as a commission. And then let's say you negotiate a price reduction to 380 as part of your work as a buyer's agent.
Hmm.
That $20,000 in benefit goes to the buyer, and we will pay you 10% of that, which is another $2,000. And what's unique about that, it's the first time that buyer's agents get paid more when they reduce the
Yeah.
purchase price, right?
That's a great incentive for them to do that. And I can see where the benefit would be in this process.
Yeah, yeah. I think good and good buyers agents have always done this and working hard on behalf of their buyers, but this truly aligns your compensation with the incentive or with the benefit that you're creating for the buyer.
Hmm.
And so we've launched this. We've gotten a lot of positive feedback from the community and the agent community in North Carolina in aligning incentives and, quite frankly, also making sure that the buyer's agent continued to earn their compensation for the work that they're doing as part of the process.
Absolutely. And the benefit to the buyer's agent is coming in with a cash offer, in an area where cash is king. Sometimes
Right.
you can get a lower accepted offer, even in a competitive situation, just by removing that financing component.
That's exactly what our agents do, right? They walk in and say, "Look, we don't need an appraisal contingency. Here's our offer. It's a cash offer. Yeah, it might be a little lower than what you wanted on a list basis, right? But you can have cash in the bank in 2 weeks."
Absolutely. And people are going to have to come off these house prices if they expect buyers to start paying the commission rather than coming out of the seller's pocket. I mean, I just don't see the same type of appreciation in home values if they're not going to be offering anything. So, especially to buyer's agents, your service is going to be very warranted. And honestly, it might be a reason for a buyer to use you because they can't afford to pay a buyer's agent. So, if you're offering the 2%, then from a lending standpoint, that's benefit number 5 that I don't think you mentioned early in the call here. So,
That's a
is
great point.
making
Yeah,
that down payment, or I'm
yeah, yeah.
sorry, paying the buyer's commission.
Paying the buyer's commission, exactly.
Yeah. Is there anything that we haven't discussed here today that you think is important that you would like to touch on before we wrap up?
No, I think this was great. There's a lot of new things here, and one of the big challenges that we're working through is how do you take this concept of ownership, take it apart, put it back together in a new way, right? And then communicate it to agents, to buyers, to sellers, to investors, right? So I appreciate the opportunity to be on the pod and all the questions. And obviously you've thought about this, and hopefully this was useful to your audience as well. And if any of the listeners have questions or want to participate as an investor, as a buyer, or as an agent, right? Please reach out. Frank at
Absolutely.
Ownify.
Frank at Ownify.com, or you can go straight to Ownify.com. Check out some of those calculators, compare a traditional mortgage to service that they're offering. See if you are an accredited investor and can invest with a minimum of $25,000 and generalized internal rates of return, upwards of 15%. I'm definitely going to be exploring this and looking for ways to invest my money. I think might start at the 25, see how we do, and then start coming in at larger amounts, because I love a turnkey investment. I love, being able to help people get into home ownership. The idea of kind of being that bank, I think it makes a lot of sense, especially for real estate professionals.
I
Thank
appreciate
you.
you saying that, Jonathan. I just want to add, this is not a solicitation to invest. And all the caveats that the SEC is going to make us say, please read the
Yes.
prospectus and all that, right?
This is
But I
not
appreciate you saying
financial
that.
advice
And it's not funny.
whatsoever. Consult your CPA, consult your investment advisors. There are no guarantees being made. This is just talking about the future of fractional home ownership, and not just for investors where it's normally been in the past, but now for first time and other home buyers as well. And Frank, honestly, I think this is just the tip of the iceberg. I can see you rolling this out into commercial properties for businesses as, alternatives to SBA loans, things of that nature to acquire assets otherwise, and probably a lot of other different industries as well. Maybe even the timeshare industry, completely disrupt that through a wide scale fractional ownership of vacation properties and such. There's some things out there, but I think that you're on a good start. And the ownership component is very key in this. So thanks
Well,
for
thank
being
you.
on today, Frank. Really enjoyed having you. And thank you all for tuning in today to listen to this exciting podcast about Ownify and fractional home ownership. I'm your host, Jonathan Klunk. We will be back in 2 weeks with another exciting episode of the Real Estate Mentor Podcast. Stay tuned. Have a great day.